Picture this. You find the perfect home, you fall in love with it, you even go to work the next day and tell all your coworkers about it. You're so excited and life couldn't be better. That is until you go into your bank the following day and find out that you don't qualify for the mortgage and can't afford the home. Not only that, but your credit score is shot, and they tell you that if you'd spoken with them earlier, you would have been able to fix it by this time, but now it's going to take you another 6 months minimum. If you never want to experience this, then you're in the right place, because in this video, I'm telling you all about the importance of the first step in the home buying process that most people actually miss. What's going on, guys? Alex Dunbar here, realtor with Real Broker, and today I'm going to be talking about getting a mortgage pre-approval. More often than not, I find that people will end up talking to a realtor first before they go out and do this, especially if they're not familiar with the process. And that's okay. It happens all the time. However, my advice is actually to go out and get a pre-approval at a bank or with a mortgage broker first, especially before you start looking at homes. The reason being is that you need to figure out what you can actually afford. Trust me, I've seen it more than once where someone starts browsing online or is driving through the neighborhood and sees an open house, which they stop in and check out, and they end up falling in love with the home. Or alternatively, the realtor hasn't done their due diligence and they start showing them homes before they've actually gotten a pre-approval. In both cases, the result ends up being that you set yourself up for disappointment. Not only that, but it usually messes with your expectations because it makes it significantly more difficult to lower them afterwards. I don't care how much you think you'll be able to. I've seen it time after time after time, and it never works out. Do not do this to yourself, I beg you. And if you are interested in just going out and looking at beautiful homes, there's always open houses on the weekend. But if you're serious about buying a home, you need to get that pre-approval. And the way I like to explain it to people is that you wouldn't go on a road trip before checking your gas. So you're not going to go home shopping before getting your pre-approval. Now, once you've gotten your pre-approval, there's a couple of other things that you're going to have to consider. Just because you've qualified for a certain amount of money, you still need to figure out whether you're actually comfortable going that high. And this is what we're going to call your comfort level versus your actual maximum affordability. And this always varies person to person. Your lifestyle will definitely play a big role in this, as well as what it is that you do for work. Because if you're on a fixed income, you know exactly what's coming in every single month, compared to if you're on commission, then this could vary drastically. And at the end of the day, if you can't sleep at night because you're so stressed out, it's really just not worth it. And this essentially just comes down to your risk tolerance, but this is definitely a conversation you're going to want to have with your mortgage professional. So where should you get your mortgage? And this is the age-old debate of should you go to a bank or should you go to a mortgage broker? There are pros and cons to each. However, I'm going to give you my opinion. And that is, in most cases, you should go to a mortgage broker. And here's why. When you go to the bank, all they have is their own product. Versus when you go to a mortgage broker, they're going to have options for several different lenders and can play matchmaker to match you with the best option. And basically, they're going to do all the work for you. The way that I best like to explain it is if you walked into a Honda dealership, they're not going to say, hey, you know what? These Hondas aren't for you. You should actually go across the street and buy a Tesla. I think you can agree that that's probably not going to happen in most cases. They're going to try and put you into whatever car is in their shop that is going to best suit you, even if there's a better option for you out there. And keep in mind, most of the time, the mortgage broker actually has access to the bank that you're looking to go to anyways. And when we talk about interest rates, they're going to be very comparable, but your broker can even at times get you a better rate than your bank. Sometimes this can be due to the amount of volume that they do. So if you're working with a broker who does a high amount of volume or essentially does a lot of mortgages, they can sometimes be able to get volume discounts. But at the end of the day, this is a decision that you're going to have to make for yourself. And there's never any harm in getting more than one opinion. One last point to add to that conversation is that when you go to the bank, a lot of the time, if you're not working with a mortgage professional, this is somebody who's doing several other things. That might be helping people with budgeting, saving, investing, or anything else. And this means that mortgages aren't their specialization. In comparison to a mortgage broker or a mortgage professional that works at a bank, mortgages is all they do. They know them inside out. To add to that, the person at the bank likely is getting paid whether they actually help you get a mortgage or not, whereas a mortgage broker only gets paid if they actually help you fund a mortgage. And guess what? There's no cost to working with a mortgage broker unless you're getting into something like private financing, but let's not even touch on that today. If you're going the standard route, you have good credit, everything else looks good, you're not going to have to pay any additional fees. Now, something I'd like to quickly add is that there are mobile mortgage specialists at the bank who don't only work 9 to 5 and do have a high level of expertise when it comes to mortgages. I personally know some very good ones, and sometimes they do have certain products that mortgage brokers don't have access to. So I want to make it very clear that I'm not anti-bank, and there's certain situations where they're a great option, but as a whole, I lean towards brokers. However, I digress. Moving on, should you choose a fixed or a variable rate? Once again, this is going to come down to your level of comfort and risk tolerance. Historically, if you go with a variable rate mortgage, it's always been shown to be better over the long run. However, if you're like me and got a variable rate mortgage 2 to 3 years ago, you're actually in a losing position, at least in terms of monthly payments in the short term. So what you need to keep in mind here is that a fixed rate mortgage is going to maintain the same level of payment for the entirety of your term, whereas a variable rate mortgage will change as the Bank of Canada changes the overnight lending rate. However, there are two types of variable mortgages. There is a floating and a static payment. So essentially what this means is with a floating variable rate mortgage, as the overnight lending rate changes, your payments will change as well. So throughout the term of the loan, the amount of principal that you're paying down will not change. However, the amount of interest will go up or down based on what interest rates do. Conversely, with a static variable rate mortgage, when interest rates change, your payment doesn't change. It's actually only the level of interest and principal that you're paying down. So as rates go up, you end up paying a higher percentage of interest and a lower percentage of principal. And when rates go down, it does the opposite. Now, this is true, but only to a point, because if rates go up too high, your payment may have to change if you're only paying interest at a certain point in time. So if you're living on a fixed income and you don't have any sort of reserves, obviously it probably makes more sense to go fixed, especially if you're already on a tight budget. Additionally, as a first-time home buyer, it's not a bad idea to go the route either as you get used to homeownership. However, if you're comfortable with making your mortgage payments and you're okay with a little bit of flexibility in payments, then a variable might be the better option for you. But once again, please consult with your mortgage broker. Next, let's talk about mortgage insurance. So mortgage insurance is required on any mortgage when you put down less than 20% for your down payment. When you do this, you're going to be charged a premium on top of that mortgage amount, and in general, this is somewhere between 2.8 to 4%. What this number is going to depend on how big your down payment is. So for instance, if you had a 5% down payment, then you're going to have a 4% premium, whereas if you had a 15% down payment, then you're only going to have a 2.8% premium. Now, keep in mind, this number will be lumped into your mortgage and you won't have to pay it up front. Something interesting to note here is that you're actually able to get a better rate for your mortgage if you have mortgage insurance. This might seem strange because if you put down 20%, it seems like it would be safer for the bank. However, because they purchased this mortgage insurance through one of the 3 insurers, they've essentially protected themselves, and that's why they can give you a bit of a discount. The insurance premium will likely push your monthly payments higher, even at the slightly lower rate, as your mortgage will be bigger. Next, let's talk about your deposit. This is a sum of money that's going to be due at the time that you commit to purchasing a home. It's generally going to be around 5%. However, there is no specific number that it has to be. But in BC and specifically the Lower Mainland, this is what we typically do. So this is going to be due at the time of subject removal or within 24 hours, depending on what your contract says. And don't worry, we're going to get to what subject removal is more in a future video. So typically it's able to be paid by way of bank draft or EFT, which is an electronic funds transfer. And if you're wondering why it can't just be done with a normal check, well, anybody can write a check even if you have $0 in your bank account. Whereas with a bank draft, essentially what happens is the bank is going to guarantee that that money will stay in your account, but you're not able to touch it. By doing so, it gives the seller a guarantee that the money is actually there. The key with your deposit money is just making sure you have it easily accessible. So not having it tied up in investments or accounts that take multiple days or weeks to transfer the funds. So remember, before you start home shopping, always get a pre-approval first. Being proactive and taking the time to do this up front will make your experience of buying a house a much smoother and happier one. If you don't have a mortgage broker that you'd like to work with, and are looking for a recommendation, feel free to send me an email and I'd be happy to connect you with one of my trusted sources. And if you're watching this video, that means you're likely considering buying or selling real estate. So if you're looking for some more tailored advice based on your unique situation, or you just want to talk about real estate, you can scroll down and click the first link in the description to book a call with me at a time that works best for you. Thanks so much for watching, and make sure you check out this video, which is going to go over the next step in the home buying process, which is how to choose the best home and some of the most common mistakes we see people make when doing so.